Welcome to the Pirls Stock Market Commentary video, your weekly window on stock market technical conditions, featuring the proprietary bull-bear point and figure market breadth summary chart for May 20th, 2018. Market breadth. With this past week's market advance, our bull-bear point and figure ratio at 1.14 rose from 1.07 last week, advancing further within bullish territory. The total count of securities in bullish or bearish patterns increased 2% to 2,952. The count of bearish stocks decreased 1%, while the count of stocks in bullish patterns increased 5%. The Pirls P&F Market Breadth Summary Chart shows us a market now 2 weeks in bullish territory. Paid subscribers have access to the Open Office Calc data from which the chart is generated. You may become a paid subscriber by visiting s2pmarketsignal.com, clicking Membership, clicking Register, and following the prompts. To subscribe to the weekly Pirls Stock Market Commentary via email, free of charge, simply enter your name and your email address in the spaces provided, and click Subscribe. The well-known market breadth indicator, the Nasdaq McClellan Summation Index, rose 135 points for the fourth advance in 6 weeks. At a positive 156.65 points, it continues below all 9 tops above plus 100 in the last 30 months, and continues above all 5 bottoms below minus 100 in the last 30 months. Volume analysis. In this week's volume analysis, the Nasdaq Composite Index ended in distribution mode, with average daily volume lower than the prior week. In the last 2 weeks, the Nasdaq had 2 accumulation days and 2 distribution days. Accumulation days are counted when the index closes up on higher volume than the prior market day, while distribution days occur when the index closes down on volume higher than the prior market day. Last week, the Nasdaq ended in neither accumulation nor distribution mode, on higher average daily volume. Momentum. The CCI 20 daily, at a positive 70.29, is down from a positive 150.58 last week. At Friday 5-4 close, the CCI 20 daily pivoted from about negative 44 at Thursday 5-3 close, forming a zero-line reject long entry signal within the plus or minus 50 range, rising to a positive 48.02 at Friday 5-4 close for a long entry signal at Monday 5-7 open. At Tuesday 5-15 close, it dropped below plus 100, so we exit the trade at Wednesday 5-16 open. The result of this trade simulation was a gain of 114.40 points on the Nasdaq, or $2.45 per share of QQQ. In Woody's CCI trading system, 6 consecutive bars above or below 0 are required for a change of trend. The weekly CCI 20 of the Nasdaq Composite Index began a Woody's uptrend 107 weeks ago, while the daily CCI 20 began a Woody's uptrend 4 weeks ago. The CCI 20 weekly rose to a positive 78.76 from a positive 73.32 last week, and outside the plus or minus 50 range required for a valid zero-line reject long entry signal. Industry rotation the last 2 weeks. All of the top 5 industries are positive, and all of the bottom 5 are negative. Summary: some tech and oil on top, some tech and REITs on the bottom. Bullish, disk drives has entered the top 5. Bearish, networkers continues in the bottom 5. REITs has entered the bottom 5. Oil continues in the top 5. Oil services has entered the top 5. Computer hardware, comp tech, and semis continue in the top 5. Focus this week from www.realinvestmentadvice.com. Consolidating the Breakout by Lance Roberts. The following are some key points and charts. Over the past week, the market did consolidate its recent breakout by pausing just above the previous resistance level of the 100-day moving average. As shown in the first chart above, this pause sets the market up for a continuation of pathway number 2 to the next level of resistance. However, there is a reasonable possibility that has opened up of a new path, number 2C, which could lead to another retest of the 200 DMA if the market breaks the current support. If the market is able to move above last week's highs, we will add further exposure to equity risk side of the portfolio. But we will do so with very tight stop-loss levels and with added hedges as necessary. A failure of support will keep our cash levels elevated, and we will wait to see where the market finds its next support before taking further actions. Our concern over the broader market remains, and I have explained that list further this week. The Fed is raising interest rates and reducing their balance sheet. The yield curve continues to flatten and risks inverting. Despite strong earnings this past quarter, valuations remain very elevated. The lack of liquidity in both the bond and equity markets are of great concern. Market leverage remains at historically high levels, which isn't a problem until it is. Credit growth continues to slow, suggesting weaker consumption and leads recessions. The ECB has started tapering its QE program. Global growth is showing signs of stalling. Domestic growth has weakened. While EPS growth has been strong, year-over-year comparisons will become challenging. Rising energy prices are a tax on consumption. Rising interest rates are beginning to challenge the valuation story. We remain invested, but are also highly aware we are closer to the end of the bullish half of the market cycle than not. Why? Valuations, silly. Only 9% of the time in history have U.S. stocks been so expensive, according to David Rosenberg, Gluskin Sheff. David's most salient point came from a quote from Federal Reserve Bank of San Francisco. He pointed out that, having access to tons of research, they themselves admit that equity valuations are so stretched that there will be no returns in the next decade. Quote, current valuation ratios for households and businesses are high relative to historical benchmarks. We find that the current price-to-earnings ratio predicts approximately zero growth in real equity prices over the next 10 years. Close quotes. Basically, the Fed is giving investors an explicit warning that the market will mean revert. But revert doesn't mean stop at the mean. According to David's calculations, if the household net worth GDP ratio reverted to the mean, savings rates would go from 2% to 6%. As a result, GDP would go down 3%, which would have nasty consequences for the economy and, in turn, stocks. Our new equation, the 10-year U.S. note yield, 3.1%, equals 0.8 inflation, 2.20%, plus real U.S. GDP, X%, We can now solve the following. Number 1. What real U.S. GDP growth rate is the 3.1% yield on the 10-year U.S. note predicting? Solving for X above produces the conclusion that the current note yield and inflationary expectations produce an implied real GDP growth rate of only a positive 1.675%, well below consensus economic expectations for 2018-19. Number 2. If real U.S. GDP growth meets the consensus, positive 2.5%, where should the 10-year note yield be? Solving this question by making X equal 2.5%, consensus real GDP projections, produces an expected 10-year U.S. note yield of 3.76%, more than 65 basis points above the current yield. The question remains whether economic growth, currently in the second longest expansion on record, can accelerate to 2.5% annually, or if the rise in rates sparks the next recession, leading to substantially lower rates of economic growth. Thank you for watching this week's Sand to Pirls Stock Market Commentary video featuring the proprietary bull-bear point and figure market breadth summary chart compiled by Donald Pirl, www.s2pmarketsignal.com. Hoping that you are enjoying a peaceful and pleasant weekend, that you are looking forward to a prosperous and productive week coming up, and wishing you true success.